Income tax and redistribution, part of our lecture series on inequality. In this video, we'll discuss how the U.S. income tax is progressive and also some of the issues involved in redistributing income. The U.S. has a nationwide tax on income. The state of Massachusetts and many other states have a state tax on income. What's interesting is the Massachusetts tax on income and the U.S. tax on income are very different, and we'll talk about those differences here in a moment. Also, some cities and towns, for instance, New York City, have taxes on income just for people living in that city. Massachusetts income tax is what we call a flat tax. Everyone who earns above $4,000 pays a little more than 5% tax on any income they earn over $5,000. It doesn't matter if you earn $2 million or $10,000. Every amount over $4,000 ends up with this tax being assessed on it. So that's the idea of a flat tax. Whereas the U.S. income tax has a more complicated structure, and the key to understand this complicated structure is that the tax rates we talk about are marginal tax rates. What does that mean? Well, here's a chart taken from the textbook of the marginal tax rates. I'm not sure if these are the exact right numbers currently, but they're close enough to understand that for everyone that earns, let's say, $80,000, for the first $9,700 of that, they pay 10%. And then for the next, from $97,000 to almost $40,000, they pay 12%. And for $40,000 up to their income of about $80,000, they pay 22%. Now that's true for anybody, no matter how much they earn. It's just that the amount you earn on the next dollar is your marginal tax rate. So for instance, someone making $85,000 a year, their marginal tax rate is 24%. If they made $85,000, that additional $1,000 would be taxed at 24%. That does not mean that their whole income is taxed at 24%. It just means that their next dollar of income is taxed at 24%. So something you need to remember when you hear about U.S. income tax brackets or rates is that that only applies to additional money that people are getting. The U.S. income tax, by having this structure of a lower rate for lower amounts of income, is a progressive tax, where people earning less money tend to pay less in taxes. And one of the programs that I mentioned in brief in our previous lecture was the Earned Income Tax Credit, which allows people of lower economic status to pay even less in tax. Some people call it negative income tax. And this is a reward or a benefit for people who are working, even though that work is not very remunerative. They don't really earn a lot of money for the money they work, but they are able to, because they're working and not receiving benefits from the government gives them this break via this Earned Income Tax Credit. Now, in general, the tax code is progressive, but the tax code is also complicated, and richer people may be able to employ strategies to pay less in taxes. For instance, someone who is very rich might only pay $750 for their tax in a year. Now, I want to sort of spend a moment talking about the larger issue of redistribution. So what we see here is a chart. Do we want to take money away from rich people and give it to poor people? There are reasons for doing this. The most compelling might be this chart right here, where an increase in income for the poor, which is this sort of rectangle here on the left-hand side, tends to make people a lot happier than the same amount of increase in income for the rich. So if this holds for everybody, taking some money away from really wealthy people and giving it to poorer people might result in our society being better off overall. That's the basic argument in favor of redistributing wealth. But the thing about redistributing wealth is, first of all, it's very, very unlikely to ever happen in the United States due to, I'm not sure what you ascribe it to, due to norms or due to political agendas or due to entrenched interests or due to lobbying or due to the way we run our elections. Whatever it might be, the idea of a massive redistribution is very unlikely to happen in the United States. There's also, if there's going to be redistribution, there's going to be administrative costs involved in redistribution, what's known as the leaky bucket, where $25,000 taken from a wealthy person might only result in $20,000 going to a less wealthy person, or maybe even less than that. Also, if we're focusing on redistribution in terms of equity, there may be some trade-off with efficiency. In other words, we will not get the efficient allocation of goods that we've talked about previously in this class. Instead, we'll get some sort of equitable allocation of goods that may not be as efficient. There may be more waste than there would be with an efficient allocation. So the Massachusetts income tax is flat, whereas the US income tax is progressive, and that means that the US income tax sort of works to redistribute some wealth from rich to poor. US income tax brackets show the marginal tax rate for a way of an income recipient, not the overall tax rate for that recipient. And redistributing wealth would allow an overall benefit to society, but there are major hurdles to implementing something like that in the United States.